We want to follow the chronological journey and look for the real tipping points. The moments where, the market or a new tax code just force the whole industry to reinvent itself.
As we get into the 80s, the stock market starts to boom, and people wanted even higher potential returns. This is what led to variable universal life, VUL.
Okay, so VUL takes that flexibility and marries it directly to the stock market. How did that work?
VUL let you invest your cash value directly into subaccounts. Think of them like mutual funds inside the insurance policy. It was revolutionary. If the market soared, your cash value could just explode with growth.
And this is where it gets really interesting because we've now gone from a guaranteed conservative rate to direct market exposure. What was the critical risk there?
The risk was losing everything. There was no principal protection. The policyholder was directly exposed to all the market's volatility.
So if you made bad investment choices or if the market just crashed,
Your cash value could plummet. It could go to zero.
and if your cash value goes to zero, what happens to the life insurance itself, the permanent protection you thought you were buying?
That's the terrifying part. The policy can lapse. The internal cost of insurance goes up every year as you get older. If there's no cash value left to pay that cost, the policy just expires.
So you could pay for decades and end up with absolutely nothing.
Nothing. No cash value and no death benefit. That tension, the potential for huge gains versus catastrophic loss, that really defined the insurance market in the late 80s.
So you've got this volatile mix of insurance and market risk, plus these amazing tax advantages from 1913. This had to have created a problem for the Treasury.
Oh, a massive problem. It's classic tax arbitrage. People figured out they could just stuff cash into these flexible UL and VUL policies.
Way more than was needed for the death benefit.
Exactly. They were basically creating their own private tax-free investment accounts. So the government had to step in and draw a line legally between a real insurance contract and what was just an abusive tax shelter.
So Congress starts putting up these regulatory guardrails. The first ones were TEFRA in '82 and DEFRA in '84.